Good morning, everyone, and welcome back to this week's episode of the Broker Breakdown with myself and Mike and a special guest we are going to announce in a second. But Mike, today it's raining, and that means the snow is going to go away finally.
Hopefully, right? We hope. You never know.
We hope. And you know what? Let's hope it stays away at least till next December, because this year's been weird because I love playing pond hockey, but we haven't had enough cold weather for like the ponds to freeze, but we've had a lot of snow. So it's like been weird because last year it was super cold and we had enough ice to be able to play pond hockey, but I felt like last year we didn't have enough snow as we did this year. So it's like kind of like the opposite almost.
Yeah, I think it's been milder just in general.
But yeah, with that extra snow, which no one likes. Well, I won't say everyone doesn't like, but for me, no go for me.
No, same.
But this week we have a special guest on the podcast. We got Alex from Tried and True Mortgages here. Alex, welcome to the podcast.
Gentlemen, thank you very much for having me on. Excited to be here.
Yeah. So do you want to kind of just introduce yourself to the listeners and kind of tell them what you do on a daily basis?
Yeah, so my name is Alex Leite. I'm a mortgage broker with Tried and True Mortgages. So we're a mortgage team in Hamilton, Ontario, under the Empire Mortgage Group brokerage there. So what we really do is we help Canadians with home financing, refinancing, equity takeouts, and debt consolidation. And we really specialize in first-time home buyers, first-time investors. So we can really help people all across Ontario and in other provinces as well, but we specialize in Ontario. So
very good, very good. And I'm just gonna kick it right off and say,
Sure.
You know what, like mortgages in the past 2 or 3 years, ever since kind of COVID kind of hit, have been a very big talking point. I know for myself and Mike, like a lot of our clients have been a little bit worried, I would say is the right word, about maybe a home that they've owned for a few years or trying to get into the market at least. I know we talked about it recently as well, that earlier in March that Bank of Canada decided not to raise rates again. Explain kind of like what's the last 5 years look like? What's the big change you're seeing right now in the market? Mm-hmm. Let's say in the last 5 years then.
For sure. Yeah. So in the last 5 years, the real estate market has really taken off. As a lot of Canadians probably know, as everyone says, we talk about two things, the weather and real estate. So yeah, the real estate market has essentially just skyrocketed. So if you look from 2018 and just even a little bit earlier up until 2022, we had massive real estate price growth. And it was really due to a lot of demand and lesser supply. So the demand for real estate kept increasing, and then couple that with in 2020 when the pandemic happened, the interest rates were reduced. Lower interest rates with higher demand led to the prices really skyrocketing. And I don't know, it depended where you were, right? If you were a first-time home buyer just trying to get into the market, this was a tough situation for you because it made it more difficult, even though interest rates were lower. But if you're already a current homeowner, or an investor, this was fantastic, right? Because your home value just went to a place where we've really never seen.
Yeah, I was hearing on the radio and stuff that you hear it all the time with any kind of real estate. Oh, we got 400, 500,000 over asking, and I was like, this is insane. And I have a lot of friends too that I think fortunately for them, they bought at the perfect time right before COVID, and they bought in Hamilton, and at that time prices were pretty low. And then even now, they said in the last 4 or 5 years since they've owned their home, they've either doubled or tripled their investment in just 5 years.
Absolutely. Yeah, absolutely. So I can sort of give you the numbers actually approximately where it was. So if you look in March of 2018, the median household, at least in Hamilton, somewhere in the $405,000 range. As of today, you're looking at, as of February, I should say, about 670,000. So right there, just over $200,000 growth in 5 years.
And that was even higher recently, like
Yes.
probably before Christmas too, because I remember I was seeing stats of Hamilton of almost in the 800,000s.
Yes, absolutely. So other than this last year, prices were continuing to increase. From approximately March of 2022 until now, we have seen prices come down. So to your point, I mean, in February of last year, right around February, March, home prices were right around the 851,000 mark. Right?
Yeah, that's insane. So literally in a year span, like it skyrocketed, but now we're already seeing it now starting to come down again.
Yeah, it's really coming back down to earth, and it's probably a better thing that this is happening, because it should have never went up to that high, those ranges in the first place. It was just really way overinflated, and when things become way overinflated, as people call them a bubble, they tend to pop, and then worse things come out of that. So
exactly.
And there was a few things too, right, Alex? Like, I mean, when we started looking at the increases back, I mean, some of the massive increases towards the beginning of COVID, where like kind of that hybrid model came into play,
sure.
Where I'm assuming that a lot of people in the GTA that had, were able to work remote, were able to sell their $1 million condo and then buy even an overly inflated housing price down here in Niagara, for example.
Yep.
Right? Like the whole value proposition changed, right? Because if you sell 700 square feet for $1 million because other people are buying that, and you can move in, let's just say 45 minutes to an hour away.
Yes.
And that same $1 million gets you like, a 2,400 square foot 2-story home.
Yep.
That it's different than someone living in Niagara or Hamilton being like, okay, I make 50 grand a year. So like the whole market was just exposed at that point in time. Right. So different times for sure.
Absolutely. Yeah, absolutely. And think about everyone in Toronto, right? If you work in the GTA and you had to work in an office building down there, and now you could work at home, is there really a benefit to you to live in an area where, let's say your family is from Hamilton and you live in Toronto? Why wouldn't you move back to Hamilton if you can work from home, right? Save on the drive, save on a lot of things. The home prices themselves. When you work from home, now you can start writing off some of the office expenses, things like that nature. So you're like you said, the value proposition really changed about work from home versus work in the office, and I think a lot of businesses realize that as well.
Yeah, yeah. And the one thing too that I found super interesting as being like, a Niagara resident for basically my entire life, was that the way that we viewed real estate down here was, that kind of that housing bubble had always kind of made its way to like, Burlington, Hamilton, but there was like always kind of a distinct change between like, going to what was the differentiating, Stony Creek, and then Grimsby, and then Beamsville, and then like St. Catharines, and then Welland. Like there was, the further you moved away, there was breaks between what housing typically was for the same types of housing between cities, right?
Yes.
And like that basically stopped when COVID happened, because then people were willing to move to like, Port Colborne, for example, these places that prior to we didn't do that. Like aside from like a few people, that was not the norm during that time.
Absolutely right. Like you just said, Port Colborne and further places. How could you have ever lived there before and worked, at a physical location? That was almost impossible to do, right? Unless you wanted to drive an hour or 2 hours every day. So yeah, to your point, a lot has changed. And I do think it does bring up an interesting paradigm of people who already live in a city, and then external residents coming to move into your city. Sometimes they've been pricing people out, right? So for example, if you move from Toronto and your house sells during the height of the pandemic, 1.5 million, and now you can get a property in Hamilton, Niagara for 800,000, you're laughing, right? But then it prices out the current residents. So it's an interesting paradigm, and like I said, there's two sides. It's great for some people. For some other people, it might not be so great.
So the one thing I kind of wanted to point towards, and I know for myself and Mike, this has been a massive thing on our end with mortgages, but kind of the difference of what you've seen, let's say in the last 5 years, from a fixed and variable mortgage, but also on the private mortgage sector, because this is a very big talking point in insurance right now.
Yeah. So are you just looking for what's happening with the rates or the differences?
What are people more going towards? Like has that changed? Like, because again, like I think more people at the, like before, I feel like we're probably going to more fixed, so they didn't have to worry about it. Nothing was changing, that kind of stuff. And then variable. I know a lot of people now have been talking about variable, but then again, like all over the news, like a lot of people are talking about how private mortgages have skyrocketed, and even on the insurance side. And this is, I tell all my clients, make sure that you are speaking to whoever you're dealing with, if it's myself or Mike or whoever it might be, to make sure that you're finding out if your actual insurance company will cover off a private mortgage, because a lot of companies actually don't even insure private mortgages. Even as a primary mortgage, they won't even do it. As a secondary mortgage, there's even less companies that will do a private mortgage as a secondary mortgage.
Sure.
So have you seen that kind of like consumer change where people have kind of gone towards a certain area because it is harder now to get a mortgage, and they're like, oh, you know what, like it's going to be easier if I go the private route?
Starting with the privates, we have seen a tremendous increase in people not only wanting privates, but needing privates. So because of the interest rate increases, the affordability has really decreased for a lot of Canadians. And so it's forced a lot of Canadians to have to go into those privates, whether it be the first mortgage or a second mortgage. Generally, we see it as a second mortgage behind a first mortgage. So with the privates, there's different risks and sort of rewards involved. A private, it's a lot easier to qualify. A lot of the time, you don't need any income verification. You don't need great credit. It's just you have to have some sort of home equity in the property, or a large down payment if you're purchasing a property. But the risks that come with it are interest rates and fees. So with interest rates, you're going to be, generally speaking, not everyone is going to be exactly like this, but you're going to be north of 8 or 9%, right? And a lot of times they're just interest only payments. And fees, you're going to be, we've seen fees as high as up to 10%. Now we try to avoid that altogether, but if somebody's in a really desperate situation and then a lender is charging that fee, there's sometimes nothing you can do. So that's what I would say on the private mortgage front. Yeah.
There's a spot too, Alex, like for the insurance and how it all relates back for those that, are interested. As James kind of touched base on, one of the big things that people don't necessarily realize, and this is a disconnect between, how it affects the mortgage side, right, to the lawyer, and then how the insurance all falls into place. Is that so people know when you have, like, let's say a standard mortgage through a regular, I don't even know what they would be called, like A lender, or is that the right term for like the top
A or B lender?
Sure. Right. Okay. Thank you. Yeah. So those ones, you're typically not going to get any problems with securing a policy with an insurance company, because most of the general standard market insurance companies, that's all fine with them.
Sure.
The only time that people get possibly into trouble is when options are brought to the table where it says, we're going to have this standard A lender, and then we're going to tack on that secondary private. So now you have the big bank or the big lender, you have your private for just a chunk of whatever else you're deciding to loan. And then when you call your insurance the day of closing, because this happens quite frequently right now when people like refinance, so you'll have your two, and the lawyer says, hey guys, bring a confirmation of insurance showing this second lender.
Sure.
You start getting in trouble with insurance at that point, because your broker or agent might say, whoa, hold on for a second. We didn't know about this. And our underwriting says, you cannot have that second lender on there. Or if it's a private, maybe there's things you have to jump through, like, what's the interest rate looking like? How much are you actually lending? There's all this other criteria, right? So there's an element to how the insurance reflects that I think general listeners need to be aware of too. And it actually helps, I guess, on your side when talking to clients saying, hey guys, this is what I'm proposing. Maybe it's smart to reach out to your broker or agent and say, I'm going to have these. Does it have any implications on my policy?
Absolutely. Absolutely. With every approval we give for every mortgage or second mortgage or whatever we broker a deal for, we always inform our clients that you need to go talk to your insurance agent, because because of those things you just specified, you don't want to run into a situation where, and you guys will know this better than I, where your insurance provider cancels your policy or changes your policy, right? Do you guys see that often? Is it policies are changed or canceled when they find a second mortgage?
There's definitely a trend that I will notice, and this is just how maybe the transaction unfolds.
Yep.
But what typically transpires is when you're adding on that second, usually the only time that we're usually informed is either A, by the client, or B, just by the client's lawyer. And it might be like the day before, 2 days before, saying, hey, we need that confirmation of insurance showing so-and-so added on.
Yep.
So the problem that addresses from that all the time is when you're super last minute on that, it puts that kind of broker, that company in a pinch, because you might not be able to get all the appropriate options back in a timely manner to suffice that closing, right? So if a lawyer says, hey, I need a binder by 3:00 today, and it's 9, maybe you don't get answers back from all of your insurance companies,
possible,
right?
That's right.
So it's definitely doable, but
it's not very helpful to us.
Yeah, I guess my point is, from a client perspective, you're almost, kneecapping yourself in a sense where you're not going to be able to get all of your best options. So then the price goes up. Maybe it's with a higher risk company. There's things that that lack of due diligence almost is going to put you in a difficult position.
Absolutely. I would I think relate this to having a pre-approval in a way for mortgages, right? It's good to get a pre-approval long before you're actually looking to purchase, so that you know all of your options and you can decipher between what you really is best for your situation. So the same would go with an insurance policy. I would assume, like with our clients, we always, after we get them their approval, we let them know to get their insurance for your home or start talking to your agent as soon as possible, because you don't know what you don't know. And once they start talking to you guys, they'll start to realize, okay, I might need more fire insurance coverage. I might need more water coverage. And that's not something that can be deciphered in a matter of 5 hours or 8 hours in a day, right? You need a good week to look at your policy and see what's best for you. I would at least assume, and that's probably what I'm guessing what you guys do with your clients.
Yeah, and it makes us, and just kind of going back to that, it kind of makes us look like the bad guys, right? Because again, you're doing all this stuff, you're trying to buy a home, like it's a very exciting time, everyone's getting super excited about it.
Yep.
And then the lawyer, whoever it might be, sends it to your insurance broker or whoever you're dealing with for your insurance, and they're like, oh, I want this in 5 hours. Well, then it makes us look bad, because if we can't get it done in 5 hours, then again, like I said, there's always going to be obstacles. Like it's like almost everything is not just a true like do this and done, right? Like for me and Mike, for example, like it's not like we have access, like because we represent, just like yourself with mortgages, we represent multiple companies, and every company has their different process. So there's some companies that are super easy, and you can send in a change like that and it's done like instantly. There's other companies you have to send it in, you have to wait for them to process it and approve it. So if you're dealing with a company like that, then again, there's waiting times on it. But like going back to what I was saying prior, it makes us look bad because we're the ones that are kind of holding up that process. But again, if things were done more in a timely fashion, like Mike was saying, then again, we can kind of get all this stuff done well before it's going to close. Like how many people I get that call me and they go, oh, I bought a house and it closes today at noon. And I go, oh, how long have you known that for? I don't know, 2 months. And I'm like, oh, so you didn't decide to call me in the last 2 months. You decided to call me like 4 hours before it closes. And like I said, it can be done, but again, it's putting a lot of time pressure to make sure that, because if you basically at that point, you have to have everything perfectly line up to make sure there's nothing that like might hold up a sale like that so that they can have a house closing. So if any lawyers are listening, if you can really send us stuff as soon as you get it, so there's more time to process things, I would love that.
And other mortgage agents, I would say, I think there is an onus on us to inform the clients that you do need these things and all the steps in the process, because if we don't let them know about that, for example, if it's a first-time home buyer, you might not know all the steps to the process, and that you need a lawyer and you need an insurance broker and you need all, set up your hydro and all those things. So I think there is an onus on us as well. So I see where you're coming from there.
There's a side piece to that too, Alex, that you might see that we certainly feel on the insurance side. So with a lot of different lenders, you might be exposed to this, but when a lender talks about, ensuring that this is the loan value, for example, but they also request guaranteed replacement cost.
Yes.
You're familiar with that?
Yes, that's right. Yep.
So the one thing that we've battled, not as much anymore, but it was very, very common for the last 2 years, is people purchasing either rentals or homes, investment properties, whatever they might be. And I'm not sure if it's the lender's conditions or kind of where it comes in, but it was, ensuring that GRC coverage was on, let's say a rental. I'll use a rental because that was very common.
Yes.
And one of the things is that a lot of standard market insurance companies may not always provide that. So this goes back to what we were just chatting about. If we get a binder letter at the 11th hour saying, well, this is the loan, for example, and it's way more than the actual replacement cost of the house, which happened during those overly inflated times, they would tack up saying, we need that guaranteed replacement cost added. And rentals didn't always qualify for it. It wasn't necessarily common to see all your markets providing that. So what we would have to do is go back and say, I can only provide up to this specific limit, or you'll go back to your lender and see if they can maybe remove that term altogether.
Yeah, that definitely makes sense. And I've seen that happen multiple times, just like you have. So the lenders, when you're getting your approval, will have specific conditions in the approval. And these are general things. So verifying your income, verifying your down payment if you're doing a purchase, verifying your property insurance. And then that's where it comes in. They want to verify that your home insurance will cover that, like you were saying, the guaranteed replacement cost.
Right.
Question for you guys. How long on average would you say it takes to actually underwrite an insurance policy though?
Just a standard home policy, for example?
Yeah.
Oh, it's not long. For example, because of the way that brokers work, most of our underwriting is front end, basically just meaning that we do it ourselves.
Okay.
And the insurance company is there to more or less issue the policy.
I see.
There's not a lot of back end underwriting, if any, if we've done our due diligence on the front side. So with all of that into play, if it's a standard home policy for a client, let's say that's had previous insurance before of some sort, claims free, the home's relatively newer in age, all of those kind of, I guess, desirable factors.
Yes.
The home policy could be done in, honestly, is from quote stage to application, under an hour.
Oh, wow. Okay.
It's very quick. There's a lot of things that go on behind the scenes that people in similar industries and clients don't always realize, which is when things get a little more sticky. That's when things like anything, even mortgages, they'll take longer to figure out a viable option.
Absolutely.
But to answer your question, it can be done very quickly if all your ducks are in a row and you're kind of that, quote, ideal client for a company.
That makes sense.
I would say it's almost even almost on the onus of the client too, because I find a lot of for me, for example, a lot of the time that's almost put into a policy, from quote to issuing, is on the client, because we have to wait obviously for their documentation, like banking and mortgage and for if it's a car or licensing, ownership, all that kind of stuff, right? So realistically for me, and I can literally quote it, send it off, and it's 15 minutes. But if the client doesn't send it in 2 or 3 days, that kind of unfortunately holds up the whole process, right?
Yeah. Similar when getting a mortgage as well, mortgage approval. If we don't have all the documents, there's no way we can get you that approval. Right?
Yeah,
exactly. So if the sooner you can get us all the information and as accurate as possible, the sooner we can get you an answer. And it's similar on the mortgage side where although we do send off the application to lenders for them to underwrite, we underwrite off the start too, to sort of get an idea of who is the best lender for this client and what are the best options for this client. And because we've sent in so many files, we'll know right away after looking at your file and collecting your documents, okay, your application will probably work with lender A versus lender B. And so that's how we can really take advantage of having the multiple different lenders, and give you the best opportunity to get approved before even sending it in.
I want to go back to what Mike was saying about the guaranteed replacement costs and how that kind of really impacted especially the insurance industry. Because I know me and Mike talked about this a lot even like last year still. But the really misconception, especially, I would say like from the whole kind of like buying process, like everyone involved, like from the real estate to the mortgage to the lawyer and the insurance broker agent that you're using, I just feel like there's so like little communication. And I think Mike mentioned this the other day, like almost like a power team that like there's no communication, because the problem is that when we had these super, super inflated home prices, real estate and rebuild costs of homes, like they do correlate, but they're not exactly the same thing, because what people don't understand is that insurance, we don't insure the value of what land costs. Because if you actually dig into what real estate prices actually break down to, a lot of it is land. Most of it really isn't what the actual like building is actually worth. So you might, like, for example, you might have a property in Oakville, for example, that's $3 million, but that home is probably, honestly, might be only worth $800,000 to rebuild. So that was the problem that we were having on the insurance side. And a lot of, like I said, lawyers and whatnot were not understanding that, because, again, a client was buying a home for $3 million, but we were only covering it for $800,000, let's just say, for very easy math. But they couldn't wrap their head around that, why we weren't covering it for $3 million. Well, it's because the rebuild cost, the home is not worth $3 million. The land in the home might be worth $3 million, but it's not worth $3 million as a property. And that's where a lot of the misconception came from guaranteed replacement costs on rentals, is that when these prices were super, super high, again, like Mike was saying, rentals, a lot of companies won't offer guaranteed replacement costs. So we were seeing a lot of times where they were trying to get mortgages and trying to cover off a mortgage, but the mortgage was way higher than what the actual rebuild value of the home was. So we were having a lot of times where we had to like search to find places in rentals that would be able to either have guaranteed replacement cost or increase the rebuild to what the actual value of their mortgage was. And that was a very, very tricky situation since COVID, because that's when prices were so inflated and we had this issue.
Yeah, that seems like it would cause a huge problem, right? If your the insurance company didn't want to give over that $800,000 in your example, but the lawyer required it, or the lender required it. Now, how do you guys go about appraising the amount that should be on the property? So how do you come up with that $800,000 number?
Mike, do you want to answer that?
Oh yeah, I love this topic, actually.
So that's why I asked you to answer, because I know this guy's going to be very passionate about it.
Yeah. So basically, it works out to be about 5 or 6 really important factors now for the rebuild cost, right? So when insurance companies say, what's the rebuild, and us as brokers are doing an evaluation tool, there's a couple big things. So very quickly, you're looking at the year built of the home. Okay. You're looking at the square footage. You're probably asking about, bathrooms. Do you have a finished basement? We're looking at a wood frame structure or something that's built with maybe double or triple brick, like an older building. Garage, those things. So when that's the majority of it, to be honest. There's little things that updates do help, but that's the majority of what goes into the evaluator. So if we take all those things, we don't necessarily manually create a rebuild cost. It comes in at where the home is located, as well as like what the home should be insured for based on those factors, Alex.
I see.
So, if we get all those things in and it says the home is 700,000, and of course with the inflated real estate market, your actual purchase is 2 million, we can't arbitrarily just insure your home for more, because the insurance policy is there to protect and insure the actual structure itself. That's what it's designed to do.
Yes.
So we can't arbitrarily increase that to cover a loan amount, because now there's 2 reasons. One, you're just insuring something that doesn't actually exist at that point. You can't over insure something just be arbitrarily. And for 2, a lot of what you pay for as a client is based, so the premium of a policy, the majority of it comes from the replacement cost. So very simply, if you had a home that was $700,000 to rebuild and you insured it for like, let's say 1.5 million, and you're basically doubling that amount, you can only imagine what that's going to do to your insurance policy premium, right?
That's right.
There's a part of that too, that if you think about it, if unfortunately that client has a total loss, which unfortunately happens, which is very sad, and they lose their entire home, the insurance company's promise and part of indemnity is to put the client back into the position prior to when the loss happened. So if it cost them $800,000 to rebuild, which is what our evaluation is saying it should, given inflation and labor and all the stuff that goes into it, paid for by the insurance company, they're going to pay you out to put you back in that position by paying for those expenses. They very rarely are just going to cut you a check for 1.5 to pay off your loan. I don't think that would ever actually happen. I've never been a part of that. So if somebody has extra expertise in saying that, it shouldn't happen, I guess is the point.
It would never happen, because if there's a claim on a building, it's not like the land is gone too. The land's still there, right? So you can still choose to not rebuild and sell the land, and you can still make money off it, because like I said, the land still has value, right?
Yes.
And I guess the point, I'll bring it back to yourself, Alex, so then it gives back to the mortgage side, is that our job is to make sure we indemnify you back to what you had prior to, but it's not to deal with the loan at all. It's to put you back in the same position as what you had happen. So we rebuild your house.
Yes.
If from a mortgage perspective, you have a clause saying, that you have to then deal with maybe a new term or new interest rates or whatever the new rebuild turns into. That's between, I guess, you and the client. We're kind of out of it at that point.
For sure. Okay. So yeah, that would definitely make sense. And to James's point is that you can still technically sell the land. So you can have the property built up to whatever the guaranteed replacement cost was. And then hopefully the land plus the new structure would be able to cover your mortgage. Because otherwise you would be in a situation where you're sort of
you have to sell, or you have to go through other means to pay off whatever that loan difference is at that point.
Yes, exactly.
And there's one actually important thing to bring it back to, if someone's sitting there saying, well, if I have guaranteed replacement cost, aren't they just going to pay for it regardless? It's a yes and no answer. The yes part of it, which is the predominant part, is that if your broker or agent has the insurance value of your home to what it should properly be, so they've done a relatively recent evaluator, and it's $800,000. Let's say it does end up costing $850 because of unknown factors that unfortunately probably do happen in claims. If your property qualified for that guaranteed replacement cost, which most do on standard home insurance policies, depending on age and everything else, but if let's take the example, if most do, the insurance company's promise is that they're going to help rebuild or repair the home, even if it's above the evaluation. Okay. So it could be $800,000 that we insured it for. It's going to cost $850 or $900. Maybe that's unfortunate. We did our due diligence. It's a proper evaluation tool. It's not underinsured by any means. It just costs more based on inflation, labor, materials, supply chain issues. The list goes on, right? It's still their promise they're going to repair or replace it. The only time a client might get in trouble in that case is if their representative was vastly underinsuring the property. And the only time that would happen is maybe your square footage is way off. Maybe the rebuilding construction materials were not remotely close to what a new common thing is. Technically speaking, Alex, it shouldn't happen. The due diligence process wouldn't allow it to happen. But a client could get in trouble if it costs 1.5 million to rebuild and it's insured for 800,000. There's going to be other talking points at that stage to say, guys, how did this get through?
How do we ever get here?
And that's why guaranteed replacement cost is so important, because this rebuild that Mike was talking about, it is updated every year on insurance. They'll usually increase it a few percentage every year, obviously based on how the market is. But that's why it's nice to have guaranteed replacement costs, because again, if things skyrocket like it did in COVID times, like insurance companies weren't going to every home policy and going, oh, this is going up 50%. So does the rebuild have to go up? They were, like I said, they were only increasing it like maybe 3 to 5% every year. right? They weren't
Absolutely.
increasing. Because imagine they took everyone's home policies and during COVID and they increased everyone's rebuild by like 30 to 50%, everyone's premium would have went through the roof. So they can't do that, right? So that's why guaranteed replacement costs, especially during times like this where inflation's super high, labor's short, so you're basically paying more for labor, materials are super high. Again, it would cover you just in case of that evaluation is just, like I said, maybe has changed since you actually got the insurance policy.
For sure. Interesting. So another quick question. If you were looking to go to a different insurance, like you asked your agent, I want to look at a different provider, would they then look at a different price, or would they look at what your home was previously appraised at?
No, we basically go through the whole process again.
Okay. Yeah.
So like, let's say like on renewal, let's say you're renewing April 1st. We usually get renewals anywhere from about 30 to 45 days out. And then at that time, we can kind of shop your policy to the other providers that we have as well.
I see. Okay, that makes sense.
Yeah, and then we basically do the whole process over again.
Alex, I love that we got you on here talking about stuff, and then you have more questions for us, which is great, by the way. It makes for great conversation. But I love how maybe it brings it back full circle too to how important some of the insurance is, even on, or I guess more insight, education on how people through that process will learn more from you as well then, right? And other mortgage agents in that respect.
Sure. I think it's super important because it's all so interconnected.
Yes.
Right?
Yes.
You can't own a home without having home insurance. You can't own a home without going through a lawyer. You can't own a home. Well, you can without going through a real estate agent, but it's not as good an idea, right?
Right.
Yeah. In order to talk to your lender, you either need to go right to the bank or you need to talk to your mortgage broker. And all of those things combined make up the entire process. So if for example, myself as a mortgage broker, I don't know about home insurance, or I don't know about the legal aspects or the purchase and sale aspects, I'm really doing my client a disservice. And I think it goes similar with you guys, right? If you don't at least have some idea, then you won't know, okay, he's at this step now, maybe we should be giving him some recommendations about what to do next.
So my question is, why don't we see more of this in the market? Why don't we see more partnerships between the industries that are connected like this? Like you I know some people, like for me, and I know for Mike, we have people that we work with, but why don't we see it more in the general public, that the people are like announcing or like showing that they're like grouped together with companies? Because then as a consumer, wouldn't you think that would kind of give more of a, you know what, like this person's also partnered with this person. They're both like very reputable companies and very reputable people. Like I want to go to them for all my services, because like Mike was saying earlier, it's like a power team.
Mm-hmm. You know what? Let me, Alex, let me think my 2 cents, and then you tell me if you think otherwise as well.
Yes.
So, James, what I think on this is that historically speaking, all professionals kind of stayed in their own lanes. So through a history of a transaction, you would see a person get a realtor in place to buy a home. They wanted to start that. You then go through the mortgage thing, get your lawyer in place, and then insurance was at the end. And everyone kind of stayed in their lane, where if you're a first-time home buyer and you don't know what to do, you don't always know the right questions to ask or the people to go to. So they'll say, find somebody you trust in that specific space and go after them, instead of it being like almost our responsibility in essence, or let's take on some responsibility.
But is it not though? Is it not our responsibility to kind of help that client?
It is. But in our respected industries, this is where I think in history, we basically said previously, I'll help with your home insurance. And then, for example, for us, it'd be like, okay, make sure you also get life insurance, because mortgage insurance products aren't maybe the best, right? Let's just say that. Mm-hmm. So that would be like where we come in too. But I don't think people historically necessarily cared about that. It was like, okay, I got to do this, but it was almost at the last minute, like when you need it, right? It was like the lawyer said, okay, guys, make sure you get your binder for insurance in. And the reason I say that is because we still see that right now. So my perception on that comes from what we still see every single day, right? So that's my thoughts on that.
Yeah, I would most likely agree with that. I do think that's correct. I do also think that there's 2 other aspects to it. First is there's specialization. So if I'm a mortgage broker, it might be beneficial for me to have an insurance broker and a lawyer in my office, right? Even if you could do that, I don't know if you could due to regulation, but I think it's probably a better idea to specialize in one thing in an office. And so the best example I could give of this is a lawyer is a lawyer, but there are multiple different types of lawyers. There's family law, there's real estate law, there's corporate law. And we've seen this happen with our clients where somebody was doing a real estate transaction. They just went to a family lawyer as opposed to a real estate lawyer. And we had a few problems with it, right? So there's that first aspect of specializing in the certain area. But secondly, I think it's just probably regulation. So I do know that real estate agents and mortgage brokers, they can have not co-licenses, but 2 licenses at a time. So for example, I could be a mortgage broker and also have a real estate license. So I could do your real estate transaction and then also obtain the mortgage financing for you. I don't know what the regulation or the guidelines would be on me also being an insurance agent or having insurance. Yeah, so there you go.
It's right? A conflict of interest right away. Especially if for 100% sure we cannot be an insurance broker and we can't be a mortgage agent at the same time. It's a conflict of interest.
For sure. And that makes sense, right? So I don't know. I would assume because of that by itself, you wouldn't be able to have an insurance agent and a mortgage broker in the same office. But you're talking about interconnectedness.
Like you need to have it like on the same team, but I'm saying more like in the relationship of like how me and you have it, where like we like work together to help our clients. Because like from a consumer standpoint, my customer experience is something that I like obviously want to drive and make sure that my customers and consumers are obviously having the best experience possible. Mm-hmm. So if they have a gap in something that they can't find in their purchase, right? They're buying a new car. Oh, here's the people that I work with for cars. Oh, I want to buy a new home. Well, here's the people that I work for with homes. Oh, I want to look at restructuring my mortgage. Okay, here's the people that I work with mortgages. For me, that is super important on how I conduct my business.
Yes.
Because I feel like, again, if I can offer them more services, and again, I'm not the one offering it to them, but at least I can kind of nudge them in a little bit of a direction that, you know what, I already trust James with my insurance, or I trust Mike with my insurance. I'm going to now trust them that they work with this person all the time for buying cars or buying homes or getting a mortgage or whatever it might be. I'm going to go to that person because, you know what, James trusts them and Mike trusts them. I'm going to trust them as well. It just, again, it's rather than like how difficult is it, or how nerve-wracking might it be to go and buy a car or go and buy a home, and it's just, you're walking into a dealership, you're walking into a real estate office, and you don't know that person, right? So you're trying to build a connection with them. But if it's already kind of like semi-built from someone you already trust, like I feel like that's a little bit better of a connection, and you're like, you know what, James already kind of knows that person, or I already trust James, so you know what, I'm going to go to deal with who he deals with, because obviously if James or Mike's a stand-up person and I trust them, I'm going to probably going to trust this person, because why would he trust them and use them if they're not a good person as well?
I think. Go ahead.
No, I was just gonna say. I know we just had a long conversation on that, but I'm actually those types of referral networks are huge. I'm actually in one myself with a few people that I do try to help out with business.
Yes.
What I'll say is, until kind of joining networks and being a part of this, we actually have valued referral partners. I think the general public is technically kind of scared in a sense, right? Because if you don't necessarily know, like, and trust someone, it's really hard to want to refer them or even change your habit as a person in the business too. Mm-hmm. So there's a big aspect of this that we all, Alex, like you said, we all kind of have our professions. We all stay in our lane. We all know what we're talking about with our own thing. But then to properly complete that transaction and say, hey guys, I just got your mortgage done. If you want, I do know a few people within insurance that you might want to get home insurance quotes from while you're shopping around. Mm-hmm. And there's like this like easy way of like leading into that conversation, which I love to do. I'm trying to do that with almost everything that I do, especially when I have different partners. Mm-hmm. But I don't necessarily think that all people have the confidence to do that, right? Like you have to actually form that habit, is what I'm trying to say.
Is it confidence, or is it straight up care for their client? Because I feel like a lot of people, and I don't want to name names, but I feel like a lot of industries just want it, and especially now, I'm not saying all the time, but I feel like right now, and like the kind of the way our workforce is really kind of developed over the last few years. Do you think people just want it off their desk and gone? I don't want to have to deal with this any further than I need to.
Sort of like a one and done transaction.
Yeah, if I can deal with this in 30 minutes, I want it off my desk. I don't need to deal with it anymore.
I think for some people, there's probably aspects of that, but I do think for the general, let's just say Canadian, we do care for each other more.
Yeah.
So to Mike's point, there is that confidence, and there is, like, what I like to do is I do like to ease in to the conversation, and I'll say, okay, you don't have to go to these people, but in case you are looking for somebody, here are some people that we've used in the past and that we've referred to in the past that have helped our other clients, right?
Well, there's another quick aspect I'll point out, and you guys might feel the same way or might not. But before I was kind of part of, referral networks and different things,
yes,
I didn't want to upset somebody further by recommending them to someone if I didn't necessarily feel confident in them. So it wasn't about doing my client a disservice by not referring them over to somebody else. What it was saying, okay, I've done my job. Let them go find their own stuff. So I don't further almost pry into like other ways that I can help. And I know people are going to say, well, that's not, you're not prying, you're just helping. But there's the flip side of that coin, which says like, I don't necessarily want to put them in a worse position by recommending them over. Maybe them having an experience with someone that I can't control. There's a part of that as well. And then being, hey, Mike, I called your partner, and they weren't a good fit, for example, right? I think people are kind of scared with that in the back of their minds.
Yeah, I think that's a great point. They're scared, and then to add on to that, I think sometimes they might believe that you're getting some sort of cut or payment for the referral.
Right.
And pretty much 100% of the time, we don't. Right? It's just out of the goodness of our advice and our experience that we should at least give you an option. Right.
And so it's funny because nobody, Alex, nobody gets offended by that if we're actually doing it in like a kind way that's like, I truly want to help you. But it's funny how like until you get into that zone, people, we don't always do it.
That's right. That's exactly it.
Yeah. I think for me, like when I'm looking out for like network partners and stuff, that's the biggest thing is like, am I going to trust you with my client? And I say this to literally every single person I work with.
Yes.
I want it to be like if I'm the one selling them or educating them on whatever it might be. If you're buying a new car, I want it to be like I'm selling my client a car. If you're buying a home, I want it to be like I'm selling them that home. Because at the end of the day, like values and characteristics that I have, I want to make sure my client's also being treated the same way if they're going to do that through a network that I have. Because at the end of the day, if a client of mine goes to someone else that I referred them to and they have a bad experience, it looks bad on my end because they're like, oh, James, you work with this person? I had a really bad experience with that person. And then it looks bad on my character, right? Because I have like a partnership with them.
That's right.
So I'm very picky. I'm very picky with who I deal with because I never want that situation ever to arise.
Absolutely. Because it's an extension of your service too. If you, let's say, provide great service, but then you refer them off to another party and that party is not giving up to par, then it's going to reflect back onto you. And so I think it's super important to be picky with who you choose, like you just said, James.
Yeah, exactly. But kind of wrapping this up, kind of the last question I have anyways is, let's say now we've already talked about the last 5 years, but maybe let's kind of move forward and let's talk about the next 5 years. What do you kind of see is going to start happening in the market? Like, is this, because I'm reading all these articles and whatnot, do you think that we're at the bottom of what's going to happen? Do you think things are going to start coming down even more? Do you think we're like kind of like stagnating a bit and now we're going to go up again? Like, where do you see this market kind of going with mortgages and real estate in the next, let's say, 5 years?
Yeah, so that's a fantastic question, first of all, because it's on everybody's mind. It's on, should I buy now? Should I buy later? In general, the demand has reduced a little bit, but the supply issue is still there. So in Canada, especially in Southern Ontario, we have a big supply issue. And once interest rates stabilize or even potentially start to decrease, I think the demand is going to skyrocket once again. And we've already been seeing that just leading up to the spring mark here, a lot more transactions are happening. And to add on to that, immigration in the next 3 to 5 years in Canada is massive, right? We're expecting in the next 3 years over 1 million immigrants. I actually wrote an article about this on our Tried and True website, where all of these immigrants, a lot of them get situated, especially in Southern Ontario. So that demand, where we already had low supply, is just going to increase even further. In other words, looking forward 3 to 5 to 10 years even, most likely real estate is going to continue to increase. There's no guarantee, but if you just use simple supply and demand, in this case, demand largely outweighs supply. And so we should expect to have that increase. Adding on to that, if interest rates begin to decrease, affordability is going to increase again. Affordability is going to go up, and more people are going to be able to afford the homes again. So there's just going to be more buyers in the market. So that's what I would say. There is some speculation about the market decreasing, like the real estate market prices trending downwards a little bit further. But I think that was all before what we saw happen with the banking situation in the United States.
I was literally about to ask you that question.
Yeah.
Do you think the banking debacle is going to change what's going to go on now? Because the Bank of Canada just said earlier in March that they are not going to increase rates right now. And then literally that same weekend, I believe, they had all these bank issues down in the States where the government had to basically like seize was it 2 banks or was it 3? It was 2 for sure, right?
2 for sure. Silicon Valley and First Republic, I believe. And Signature Bank is potentially having issues as well. But that's going to have a huge impact, because a lot of those issues of their liquidity issues and essentially failing as a bank was due to rising interest rates raising interest rates so quickly. So if we look at it from a macroeconomic level, from the Federal Reserve and the Bank of Canada, you start to think, okay, inflation is really bad right now, and it is bad. But what is worse, inflation or bank runs upon bank runs? Because once one bank fails, it's a domino effect, right? It's not just one.
Well, you saw it. They won, like, I think it was Saturday, the first one went, and then literally Sunday, I kept seeing like all these other ones were going, and I'm like, whoa, this is like, and they said they've never seen anything like that in a weekend where like these major banks all of a sudden just basically failed instantly.
Exactly.
But but I think we were talking about this earlier too. I was telling Mike this. I read an article about it. Did you know that one of the banks, Silicon Valley, I guess the week before paid out all their executives a massive bonus, and then because they knew it was coming, like, and how does that ethically like allowed to happen? I think they're going to get reprimanded for that. Somehow, some way, I think they will, because I don't think you're allowed to do that.
I mean, if it's the executives giving bonuses to themselves, I guess who can really stop them? But criminally, is there some criminal intent there? That's up for the lawyers in the United States for the law to determine in the United States.
Exactly.
So, but it could have a huge effect, and if we continue to see things like this, we should expect interest rates to decrease and decrease rather quickly.
Interesting. Yeah, because I think I read an article that basically said like basically half of Canadians, if it raised any more, they would probably have to sell their home. And another article I read too is that basically anyone that bought a home since COVID might be stuck in this home, because to get out of this house now, they will either lose money or it's just not feasible to get out of a home that they bought in the last 3 years.
Yeah, that's definitely a thing, a concern that is arising right now, because if you bought a home, not so much in 2020, but let's say 2021 and 2022, that home price might be lower than where you purchased it.
And that's what a lot of people are saying right now, because again, we didn't go over the article by Desjardins, but Desjardins released an article on housing prices. And let's just use Hamilton, for example. They predicted that by the end of 2023, the Hamilton-Burlington area is going to decrease another 35%. And there's areas in Ontario that they said up to 54% decrease on home prices. So imagine you bought a home 2 years ago, and now you're basically saying there's already been decreases a little bit, because even you said from February of last year to February of this year, we've already seen a little bit of a decrease. But imagine another like even 30% decrease from there. Like imagine what what you bought your home for, and then now your home's worth like 30% less in like a year.
Yeah.
It's like the flip side of how when COVID started, you bought a house before COVID and it's gone up like triple. And now it's like the opposite. Now it's like going down triple.
Yeah. No, it's a tough situation, because then at the same time, you are in a scenario where your mortgage potentially is actually
inflated,
is a larger balance than your home value. Right. So this is something I call checkmate bankruptcy, because if you try to sell, you sell for less than you purchased, and now you can't pay out your mortgage. And if your mortgage payments have went up due to variable rate or having to renew into a different fixed rate, and you can't afford those payments, you essentially are gonna end up in a bankruptcy situation. So it's very, very tough, and I really feel for people who are in that situation. There are some ways to navigate it and try to potentially, make the best of a bad situation. So we try to help people out in that regard, but sometimes there isn't too much you can do. But you always have to take a look, right? You have to take a look and see what you can do for people.
And that's why we get the experts like yourself involved in those situations.
Absolutely. Yeah, absolutely. That's exactly what we're here for. Because like I was saying before with the other topics, you don't know what you don't know. Before I got into, the mortgage brokerage side, I was in finance for over 4 years. I didn't know all of the avenues we had and all of the different lenders we could offer to help out Canadians. So yeah, definitely.
Mike, do you got anything else for Alex before we wrap up?
No, I really want to thank him for coming on. I mean, we did, this has probably been very close, if not the closest to our longest episode too, I think.
Yes, it has. And you know what? Like I said, I really want to thank Alex as well for taking the time to come out. I know we had a little bit of technical difficulties early on in the week, and we had to kind of reschedule because it wasn't just kind of working out for us, and we kind of wanted to recharge and make sure to get the vibes back. But I think the vibes have been great today. I think, Alex, you've given a lot of information. But you know what I like about this episode? Yes. I like that you've asked questions too, and we've been able to kind of relate that back to the insurance side of things, because I do like when you kind of talk and stuff and you give the information, but I like how we've kind of wrapped it, like Mike was saying earlier. We kind of did it a full circle. You gave your points, and then you kind of asked us questions about the insurance side of things, which, again, I really appreciate, because, again, that kind of gives you more knowledge and your clients more knowledge moving forward, that you be like, you know what? I didn't know this prior to the podcast. Mm-hmm. Now I can go back to my clients and tell them this stuff and educate them a little bit more on the insurance side of things.
For sure. Well, first off, thank you very much, guys, for having me on. This has been fantastic. But just building on your point there, it's fantastic to be able to come on this podcast with other professionals, and then, like you said, get those tidbits of information. Now, I'm not going to be the insurance expert. That's what I'm going to refer off to you guys for. But at least I can be aware of those instances and scenarios that tend to come up. So yeah, I really appreciate you coming on and learning those things to be able to help our clients, right?
Exactly, and vice versa. But we'll be posting this, like I said, next Tuesday when every episode comes out. So if you guys haven't checked us out already, make sure you guys check out on all the streaming services: Spotify, Apple, Amazon, Google. The list goes on. YouTube as well for audio for now, anyways. Like I said, Tuesdays, 12 p.m. Eastern time, we basically are released. And for Alex, we'll be putting all of his socials and website in the description as well. So you want to check him out. Definitely give him a look and give a look at Tried and True Mortgages in Hamilton there. And again, if you have any questions for him, definitely reach out to him as well.
Awesome. Thanks so much, guys.
No worries. Thank you guys for tuning in this week, and we'll check you guys next week on the Broker Breakdown.